Hey everyone, and welcome back to my channel. Today we're diving into investment banking. It's a world that often seems shrouded in mystery, with images of high rises, sharp suits, and fast-paced deals. We've all seen the movies, right? The Wolf of Wall Street, The Big Short. They paint a pretty intense picture. That's why I wanted to share my own experiences and break down what investment banking is really all about. Cracking the code, demystifying investment banking. So, what exactly is investment banking? In a nutshell, it's all about helping companies navigate the world of finance. Think of it as a bridge between companies that need capital to grow and investors who are looking for opportunities. Unlike your typical commercial banks, investment banks specialize in more complex financial services, like helping companies go public or raise capital. It's a high-stakes world where billions of dollars are at stake, and the decisions made can have far-reaching consequences. By the end of this video, my goal is to give you a solid foundation of knowledge about investment banking. Beyond the vault, how investment banks differ. Alright, so we've established that investment banking isn't your typical trip to the bank. Instead, investment banks operate in a whole different realm of finance, one that's far more intricate and specialized. Think of commercial banks as the corner stores of the financial world. Investment banks, on the other hand, are more like specialized boutiques, offering bespoke services to a select clientele. Investment bankers act as trusted advisors to corporations and institutions, guiding them through the intricacies of the financial markets. Guiding growth. The role of investment banks. So we know investment banks don't handle your everyday banking needs. But what exactly do they do? In essence, they act as financial architects, helping companies and institutions achieve their strategic goals by navigating the complexities of the capital markets. They connect companies with investors, venture capitalists, private equity firms, and even the public market through an IPO, who are willing to provide the necessary funds to fuel growth. Investment banks also advise companies on mergers and acquisitions, helping them expand their market share or acquire new technologies. The client roster who seeks out Wall Street. Investment banks work with a wide range of clients, from startups with disruptive ideas to multinational corporations with household names. They also advise governments and public institutions on large-scale infrastructure projects, debt financing, and economic policy. Think tech giants looking to acquire innovative startups or energy companies seeking funding for renewable energy projects. Investment banks are drawn to clients with ambition, those looking to make a significant impact on their industries or even the world. Equity financing, fueling growth through ownership. Let's say our ambitious company decides to seek funding. One path they can take is equity financing. In simple terms, equity financing is like selling pieces of your company's ownership in exchange for cash. Think of it like this: you're baking a cake, but you need a bigger oven and better ingredients. Equity financing is like inviting investors to join your bakery. They provide the capital you need, but in return they get a slice of the cake or shares of your company's stock. For many companies, especially those with high growth potential, equity financing is a valuable tool for fueling expansion and achieving their long-term vision. Going public. The IPO Spectacle. One form of equity financing that often captures the headlines is the initial public offering, better known as an IPO. This is when a company decides to sell shares of itself to the public for the very first time. An IPO is a momentous occasion for any company. It's a chance to raise significant capital, increase brand awareness, and even create wealth for early investors and employees who hold company stock. The investment bank acts as the conductor of this intricate orchestra, guiding the company through every step of the IPO journey. They help the company determine the initial offering price of their shares and market the offering to potential investors. Beyond the IPO, other avenues of equity financing. While the IPO might be the most well-known form of equity financing, it's certainly not the only one. Companies, especially those in the earlier stages of growth, have a range of options when it comes to raising capital through equity. One such option is venture capital. Venture capitalists are investors who specialize in providing funding to startups and emerging companies with high growth potential. Another avenue is private equity, where firms typically invest in more mature companies, often acquiring a controlling stake in the business. Debt financing, borrowing for growth. So far, we've explored how companies can fuel their growth by selling equity, but there's another side to the financing coin. Debt financing. Just like individuals can take out loans, companies also borrow money to fund their operations and expansion plans. Debt financing involves taking on debt obligations that must be repaid over time, typically with interest. Debt financing can be a strategic tool for companies, allowing them to access capital without diluting ownership. Bonds, tapping into the debt market. When it comes to debt financing, companies have various options at their disposal. One avenue is through the issuance of bonds. Bonds are essentially debt securities that represent a loan made by an investor to a borrower, typically a corporation or government entity. Investors who purchase these bonds are essentially lending money to the company. Investment banks play a crucial role in the bond market, acting as underwriters and advisors to companies seeking to issue debt. The Debt Balancing Act, weighing the options. Debt financing, while a powerful tool for growth, is not without its considerations. Companies must carefully weigh the benefits and risks before taking on debt obligations. One key consideration is the cost of debt. Interest payments on loans and bonds can impact a company's profitability. Companies must strike a balance between debt and equity financing, finding the optimal capital structure that supports their growth objectives while maintaining financial stability. Mergers and acquisitions, the art of the deal. So far, we've explored how companies can fuel their growth organically through various financing methods. But there's another, more strategic avenue for expansion, mergers and acquisitions, often referred to as M&A. Mergers involve the combination of two companies into a single entity, often with both companies' management teams playing a role in the newly formed organization. Acquisitions, on the other hand, involve one company, the acquirer, purchasing another company, the target, which is then absorbed into the acquirer's operations. Why merge? Unlocking the strategic rationale. The decision to engage in M&A activity is rarely taken lightly. Companies pursue mergers and acquisitions for a variety of strategic reasons, each aimed at enhancing their competitive position and driving long-term value. One common driver is market share expansion. By acquiring a competitor, companies can quickly gain a larger foothold in their industry. Another rationale is gaining access to new technologies or products. M&A can also be driven by the need to streamline operations and reduce costs. The investment banker's role, guiding the M&A dance. Mergers and acquisitions are intricate dances involving multiple parties, complex negotiations, and significant financial stakes. Navigating this complex landscape requires specialized expertise, and that's where investment bankers take center stage. Think of investment bankers as the choreographers and negotiators of the M&A world. They act as trusted advisors to companies considering mergers or acquisitions, guiding them through every step of the process, from identifying potential targets to structuring the deal and navigating regulatory approvals. Investment bankers conduct extensive due diligence on potential targets, analyzing their financial performance, market position, and potential synergies with their client. They also help determine the fair market value of the target company, a crucial factor in negotiating a favorable deal. Once a target is identified, investment bankers facilitate negotiations between the acquirer and the target company, working to bridge any valuation gaps and structure a deal that meets the objectives of both parties. Beyond valuation, navigating the intricacies. Valuation is critical, but not the only factor in M&A success. Investment bankers address other crucial considerations. Regulatory approval is one such consideration. Deals face scrutiny from antitrust regulators. Bankers guide companies through regulatory hurdles. Integration planning is also crucial. Combining companies is complex. Bankers develop comprehensive integration plans. Their role extends beyond numbers. They guide companies through every M&A stage. The allure of Wall Street, unveiling the appeal. We've journeyed through investment banking, exploring its high-stakes deals and pivotal role in the global financial landscape. What attracts ambitious individuals despite the demanding hours and relentless pressure? The allure is a blend of intellectual stimulation, financial reward, and headline-making deals. Investment banking offers insights into corporations, markets, and the global economy. The intellectual challenge is a major draw. It requires analytical skills, financial acumen, and creative problem solving. The financial rewards are undeniable. Signing off. Final thoughts and future explorations. As we conclude our exploration of investment banking, it's an industry in constant flux, Evolving with technological advancements and regulatory changes, the rise of fintech is transforming the financial landscape. Investment banks are adapting, embracing new technologies. The 2008 financial crisis led to increased regulation and scrutiny. Despite challenges, investment banking remains vital, supporting economic growth. I hope this video provided a deeper understanding of investment banking. If you enjoyed this video, please give it a thumbs up and subscribe. Until next time, happy learning.